Welcome to NC Academy. Today we are discussing cost volume profit analysis with you. This is our part 1. This is commonly referred as break-even point calculations. This video is helpful for GC A-level accounting students, business undergraduates, and those who are studying for professional exams like CA, CIMA, ACCA, and AAT. This video is for part 1 of our topic, which within that we will discuss cost behavior, contribution, total contribution, and profit calculation, including contribution to sales ratio. Part 2 of this video will cover break-even point calculation, and after that we will discuss CVP graph, sensitivity analysis, and multi-product break-even point analysis by using our part 3, 4, and part 5 videos. Let's start with this entire concept with John. Let's see how John is managing his business. He's selling newspapers. He sells a newspaper at ₹30, but he has to pay ₹25 to the agent who supplies these newspapers to him. Each and every newspaper he sells, he will earn a margin of ₹5. He don't have a complex cost structure, and his only cost is ₹100 per day for this table just in front of a shop. What are his worries? I think he probably worrying about, can I earn enough money to pay for the table? If not, am I losing? What is my profit if I could sell 50 newspapers? Essentially, these are the same questions any business is facing, but with different level of complexities. CVP analysis is that part of management accounting deals with these types of issues. To understand cost volume profit analysis, it's very important to understand cost behavior. Cost behavior refers to the relationship between total cost and activity level. Activity level can be number of units, or it can be sales value. Based on behavior, in the sense how individual cost behave with level of activity, the costs can be categorized into 2 components. That's fixed or variable. There are some costs with both variable and fixed behavior. We refer them as mixed cost. It could be either semi-fixed or semi-variable. For simplicity, I'm not going to discuss about this semi-fixed or semi-variable in detail. Let's start with fixed cost. So as I explained to you earlier, cost behavior refers to relationship between cost and the activity level. The fixed costs are the costs which do not change with the level of activity within the particular range. So example are factory rent, depreciation, etc. As you can see with this example, these fixed costs are cost relates to particular period rather than number of units that you produce. Let's see how this fixed cost relationship works with the volume by using this table. As you can see this table, we have 3 information presented in this table. First is activity level. So activity level can be 0, we don't produce anything, or it can be 1,000, 2,000, 3,000, 4,000, or 5,000. The most important characteristics of fixed cost is it would not change with the level of activity. It would not change with the level of activity. However, since it is not changed with the level of activity and remains unchanged, but when you're increasing your production or activity level, number of units, so fixed cost per unit will decrease. Now let's see how this fixed cost relationship can be represented by a graph. Well, let's look at this one. This is a total fixed cost graph. In x-axis, you can see sales in units, it's quantity. In y-axis, you can see cost. As you can see in this graph, this line, it's at 100,000 level, irrespective of the volume it can go through. So let's see the graphical representation for fixed cost per unit. As you can see very clearly in this graph, when you are producing more, when you are selling more and more units, your 100,000 can be shared by many number of units. So eventually, cost per unit will decrease. I hope you understood how fixed costs relate. But with everything, you should understand the fact that the fixed cost is period cost, not a unit cost. Let's go for variable cost. Unlike fixed cost, variable cost will increase in proportion with the volume. If you look at this diagram, it's very clearly, you can see that very clearly. Examples for variable cost includes direct material, direct labor, direct overheads, packing cost, etc. Now look at this diagram, this table. In this table, when you increase in the sales quantity, your variable cost per unit remains unchanged. But however, your total variable cost will increase. Why? Variable cost per unit is 50, and when you are producing 1,000, so your total variable cost becomes 50,000. When you're producing 2,000, it becomes 100,000. 3,000, it becomes 150,000, and so on. It's very important to understand, unlike fixed cost, variable cost is unit cost. So how total variable cost will behave? So get the very same graph. So you're increasing sales units, and this is your cost. Cost increase in proportion at a 50 rupees per unit rate. But variable cost per unit remains unchanged at 50 level. This is little different from what you can probably learn under economics. In economics, when you are increasing your volume, variable cost can decrease. But once you pass some particular level, it could again increase. So if you see my cursor, and then like you can see, so that relationship is something like this, rather constant line. But this is what management accountants believe for the purpose of CVP. That's assumption, right? So all what you should remember at this particular point about that, this is different from what you learn under economics, right? So sales revenue, this is not really part of cost behavior, but it's very important that we understand this as well. So total sales revenue always increase in proportion with the number of units sold. More you sell, more the revenue at a constant rate, which is your sales price. That you can see in this diagram. Your sales price per unit is constant at 80. When you are increasing your activity level to say 1,000, 2,000, 3,000, 4,000, and 5,000, so on, your total sales revenue will also increase at the rate of 80 rupees per unit. Again, this is slightly different from what you are learning under economics. Just keep that in your head. Otherwise, you go and compare that with economics. Total sales revenue, it's always increase at the rate of, in this example, 80 rupees per unit. But sales price per unit remains unchanged at 80. These are our assumptions, right? So now, having understand how fixed cost, variable cost, and sales revenue behave with each other, behave with the volume, let's see how can we calculate this contribution per unit and total contribution. So it's very important to understand contribution is the difference between a sales value and variable cost. So this is not profit. Why it is not profit? Because we haven't deducted all our cost. We only deducted variable cost from total sales. So we have not deducted fixed cost here. So why contribution? I always remember it, thinking that this is what contributes to cover fixed cost and then to make profits for us. So that's how I used to remember it. So this total contribution is total sales minus total variable cost. Also, we can calculate contribution per unit, which is essentially sales price per unit minus variable cost per unit. Right. So then we'll see what's our total contribution. Alternative way of calculating total contribution is you can get contribution per unit multiplied by number of units. This SP represents sales price, VC represents variable cost per unit, and essentially SP minus VC is our contribution per unit, and Q represents quantity. So total contribution is sales price minus variable cost times quantity. Let's take example. Sales price per unit is rupees 75 and variable cost per unit is rupees 40 and number of units sold equal 5,000 units. Calculate contribution per unit and the total contribution. Let's see first. Your sales price is 75, variable cost per unit is 40, so your contribution per unit is 35. Then your total number of units, which is Q, equals 5,000 as for this example. So your total contribution is 35,000 multiplied by 5,000, which is 175,000 in this example. Let's see how profit can be calculated with this information. So as I mentioned to you, contribution is before deducting fixed cost. So essentially, if you deduct fixed cost from your contribution, so what you ended up with is your profit. So let's see. So in this example, our selling price is 250. We have direct labor, we have direct material, we have variable overhead, we have variable packing and selling cost, and we have indirect overhead absorption. Remember, this is absorption. This is not a variable cost. And then we have a fixed cost, again, which is not per unit, which is for the period. So number of units sold is 2,500. Shall we calculate in order? Now, first thing we should calculate is variable cost per unit. Essentially, variable cost per unit includes direct labor, it includes direct material, it includes variable overheads, it includes variable packing and selling cost, but it does not include indirect overhead absorption. So variable cost per unit is 100 plus 50 plus 30 plus 20 equal 200 per unit. Let's calculate contribution per unit. Contribution per unit is sales price minus variable cost. In this example, it is 250 minus 200, so rupees 50 per unit. What's the total contribution? Now, each and every unit give you a 50 as your contribution, and your total number of units sold is 2,500. So your total contribution is 2,500 times 50. That is 125,000 rupees. Last one, what is your profit? What we haven't deducted, which is fixed cost. So from your contribution, which is 125,000, you can deduct 50,000. That's your fixed cost. And then you will arrive at profit, which is 75,000 by selling 2,500 units for that particular period. Right. So maybe I suggest you pause this video for 2-3 minutes and take a piece of paper and try to work out. To work out this, you may use information presented in the previous example. That means you can consider your sales price equal to 150 per unit, and you can consider your total variable cost equal to 200 units. So give it a try. Okay, let's see. Right, this is the answer. Check whether you got it right. Right, let me explain. At the initial point, you don't produce anything. So you don't have sales, you don't have variable cost, but you can't avoid fixed costs so that you have a profit of 50,000. That's your max loss of 50,000, sorry. You have a loss of 50,000, that's your maximum loss. So let's say you are producing 1,000 now. So your sales price per unit is 250. So you can make 250,000 sales revenue, but you have a variable cost 200 per unit. For 1,000, it is 200,000. So you will end up with 50,000 total contribution, and your fixed cost is 50,000. So you don't get anything, your profit is 0. Let's say 2,000. So the very same, 250 into 2,000, 500,000 is your total sales. 2,000 into 200, 400,000 is your total variable cost. So you are ended up having total contribution of 100,000. Your fixed cost is 50, your profit is 50, and so on. Other thing you can see in this table, look at this 1,000. At 1,000, your profit is 0. Loss also 0, that means. So important thing you must learn, if you produce 1,000, you are making no profit, no loss. Up to 1,000, you are making losses. Above 1,000, you are making profit. Then this 1,000 is what it called break-even point. The quantity at break-even point. Point at which gives no profit, no loss. In our second video, which is part 2 of this series, we will learn this break-even point calculation in a bit of detail. For the time being, we can keep it. We can keep it at that level, and in the next video, we will learn those formulas. Right. Before we move on to that, the second video, to end in our initial concept, there's another thing you must learn. That is contribution to sales ratio, CS ratio. Or some people termed it as profit volume ratio, PV ratio. I like the term CS ratio. Why? It gives a direct meaning to your formula. Contribution to sales ratio. Contribution to sales ratio. It is your contribution as a percentage of sales revenue. This can be calculated with or without per unit data. This is very important concept when analyzing cost, volume, profit per services revenue, where you don't have units. You're producing services, you don't have a unit involved. So this concept is very important. Let's see formulas. Number one, CS ratio is your contribution per unit divided by selling price per unit to 100. That means you calculated by using per unit data. Or you can calculate CS ratio equal total contribution divided by total sales into 100. Shall I go through few examples to better understand this calculation, this contribution to sales ratio calculation? Example number one. In this example, selling price per unit is rupees 150 and variable cost per unit is rupees 100. So what is the cost? What is the contribution to sales ratio? So you can see what is your contribution here. 150 is selling price, variable cost is 100, contribution is 50. That 50 as a percentage of 150, which is 50 divided by 150, should be 33.33. Right? So next example. In this one, we don't have a per unit data. Instead, we have a total data. Your total sales revenue is 5 million and total variable cost is 3 million. So in this case, your contribution is 2 million. That 2 million as a percentage of total sales revenue of 5 million, it ended up having 40%. Sometimes you can calculate CS ratio without having any of this information, but simply analyzing the pricing policy. Let's see. This company is providing services and keeps a margin of 30% after variable cost. If you refer it as margin, always remember margin is as a percentage of sales. So if you're keeping 30% margin, means your variable cost, if your sales is 100, your profit is 30, so your variable cost here is 70. In that case, your contribution 30 as a percentage of total sales, which is 100, is 30%. In that case, it's obvious. You should not do any further calculation if you say margin. Second one, company is providing services and set its sales price with a 50% markup of the variable cost. This is different. This is where your variable cost is 100 and you add 50% markup to arrive at sales price. In this case, your sales price is 150 and your contribution is 50. So you are making 50 contribution for 150 sales price. So that's equivalent to 33. In both example 3 and 4, the important point you have to remember, I said margin after variable cost and markup of the variable cost. That's the word I use. So I use the variable cost. So remember, if someone come and say it is 30% margin after full cost, then your contribution to sales ratio is not 30. Then you don't have enough information to calculate at that particular level. So for you to directly get that, your pricing should be based on variable cost. Then you can easily get. Otherwise, you will where the price is set at markup of 50% of the total cost, then you are wrong, right? But here I can do this just because it's variable cost. Just remember that. Right, that's all. Thank you. This is part 2. We'll cover break-even point calculations. So this is part 1, and in the part 2 of this topic, we'll cover break-even point calculation. If you like this video, mark it. Subscribe us. Much more to come. So we will start with video 2, video 3, video 4, and video 5 of this series. Thank you very much.